I'm talking about index funds, which aren't perfect, but they're the best way to go if you want to put your money on autopilot and you can't spend a lot of time looking at individual stocks, just to buy and bet on the whole market. So if you just had a kid, you can take a couple of hundred smackers and buy some shares in an index fund for them. I'm partial to cheap ETFs that mirror the S&P 500 because those 500 stocks represent the bedrock of America's publicly traded companies. As a companion, I like any sort of total return fund that has an even broader array of stocks. A mix of both, I think, is a terrific way to start.
Performance, diversification, and smart investment. Index funds have historically offered investors a straightforward way to access diverse assets, often mirroring market indexes like the S&P 500 or the Nasdaq Composite. Choosing the right index funds is crucial for maximizing returns and managing risk in your investment portfolio. So, how do we pinpoint the best options? Let's dive in and uncover the top performers for 2024. Number 6 is the Fidelity Total International Index Fund, or FTIHX. The Fidelity Total International Index Fund selects stocks from the MSCI All Country World Index, which assesses the performance of both established and emerging markets worldwide, excluding the U.S. This global focus allows investors to diversify their portfolios and potentially broaden their professional horizons by tapping into international markets. With Nestle, Alibaba, Samsung, and Toyota among its top holdings, this fund boasts a diverse range of investments totaling more than 4,800 stocks. Since its inception in 2016, the fund has delivered an average 5-year return of approximately 6.12%. While this return may seem moderate compared to some other funds, it reflects the stability and consistency of this index fund over time. It's important to note that the primary appeal of this fund lies not in chasing the highest returns, but in its cost-effectiveness and long-term stability. With a remarkably low cost-to-income ratio of 0.06, investors can benefit from minimal fees, translating to just $6 in taxes per year on a $10,000 investment. This cost efficiency enhances the overall appeal of the Fidelity Total International Index Fund, making it an attractive option for those seeking steady, diversified growth in their investment portfolios. Number 5 is the Fidelity Zero Total Market Index Fund, or FZROX. The Fidelity Zero Total Market Index Fund, known as FZROX, focuses on equities included in the Fidelity U.S. Total Investable Market Index, which aims to replicate the performance of the U.S. stock market. What makes FZROX unique is its groundbreaking zero-fee structure, which is the first in the world of index funds. Essentially, investing in FZROX costs investors nothing annually, offering an unprecedented opportunity for cost savings. Since its inception in 2018, FZROX has delivered an impressive average 5-year return of 14.27%. This means that if you had invested $10,000 in 2018, it would be valued at more than $20,000 by the end of 2024. With a portfolio of more than 2,600 equities, including major players like Apple, Microsoft, and Amazon, FZROX offers investors exposure to a wide range of U.S. stocks. Number 4 is the Fidelity Zero Large Cap Index Fund, or FNILX. The Fidelity U.S. Large Cap Index aims to mirror the performance of U.S. large cap firms, which are companies with market capitalizations exceeding $8.5 billion. These established companies often have a track record of providing high-quality products and services, driving sustained growth over time. With a portfolio comprising more than 500 household stocks, this index fund offers exposure to well-known brands that consumers regularly interact with. Since its inception in 2018, the fund has delivered an impressive average 5-year return of 15.32%. For instance, a $10,000 investment made in 2018 would be valued at over $21,000 by the end of 2024. However, it's essential for investors to maintain diversified portfolios that encompass various industries, market caps, and investment types rather than solely relying on large-cap stocks. While the Fidelity U.S. Large Cap Index Fund provides valuable exposure to this market segment, it's advisable not to overweight it in your portfolio. Number 3 is the Fidelity Nasdaq Composite Index Fund, or FNCMX. The objective of the fund is to invest in stocks that contribute to the total return of Nasdaq-listed U.S. stocks. The Nasdaq 100 has consistently outperformed the S&P 500 over the past 15 years, largely due to its significant holdings in major companies. This includes Apple, Microsoft, Amazon, and Google, which collectively account for about half of the S&P 500's total value. However, some critics argue that this focus on large-cap tech stocks results in a lack of diversification within the fund. To address this concern, investors can consider combining this fund with other total market funds to achieve greater diversification across various sectors and industries. Despite concerns about diversification, the index fund has delivered impressive returns over the past decade, with an average 5-year return of 17.31%. For example, a $10,000 investment made 10 years ago would be valued at nearly $44,000 by the end of 2024. It's important to note that the fund's higher expense ratio, at 0.31%, may impact overall returns. Investors can mitigate this by exploring alternative investment options, such as the Invesco NASDAQ 100 ETF, which offers exposure to the NASDAQ 100 index with a lower expense ratio of 0.15%. But before we move on, we just want to thank you for watching this far in the video. Number 2 is the Fidelity Total Market Index Fund, or FSKAX. The fund invests in equities included in the Dow Jones U.S. Total Stock Market Index, aiming to capture the overall performance of a broad range of U.S. stocks. While it shares many similarities with FZROX, one key difference is its transferability. Unlike FZROX, investors can transfer FSKAX to a new broker at any time. For instance, if an investor decides to switch from Fidelity to Vanguard, they can seamlessly transfer their FSKAX holdings. Currently, the fund holds over 3 stocks, including major players like Apple, Microsoft, and Amazon. Over the past decade, FSKAX has delivered an average 10-year return of 12.36%. Meaning a $10,000 investment made 10 years ago would be valued at just over $31,000 by the end of 2024. Furthermore, the fund boasts an incredibly low expense ratio of 0.02%, translating to just $2 per year on a $10,000 investment. This cost-effectiveness, coupled with its solid performance history, makes FSKAX an attractive option for investors seeking long-term growth in their portfolios. Number 1 is the Fidelity 500 Index Fund, or FXAIX. The FXAIX Index Fund mirrors the performance of the S&P 500 Index, which tracks the 500 largest U.S. firms. However, FXAIX's stock portfolio actually comprises more than 500 major U.S. corporations, including tech giants like Apple, Amazon, and Microsoft. Over the last decade, the fund has delivered an average 5-year return of approximately 14.76%, meaning a $10,000 investment made 5 years ago would now be valued at almost $18,000. Despite not being entirely fee-free like some other Fidelity index funds, FXAIX boasts an incredibly low expense ratio of 0.02%. This translates to minimal costs for investors. It's like paying only for a small order of fries at McDonald's each year on a $10,000 investment. Investors seeking long-term wealth accumulation may find FXAIX to be a top choice. Depending on their investment objectives, FXAIX offers exposure to either the entire market or the S&P 500. However, it's important to note that FXAIX does not include exposure to small-cap stocks, as the S&P 500 index primarily focuses on large-cap companies. Now, just like any investment, index funds have benefits and potential drawbacks. On the positive side, index funds offer low costs, broad diversification, and the opportunity to match market returns. However, investors should also consider factors such as tracking error, limited flexibility, and the potential for market downturns. It's crucial for investors to thoroughly understand the characteristics of index funds before diving in. This includes knowing the index being tracked, the fund's expense ratio, and any associated risks. By conducting proper research and staying informed, investors can make sound decisions that align with their financial goals. So, what benefits and drawbacks do you see in investing in index funds, and how do you plan to mitigate potential risks? Share your thoughts in the comments section below. And that's it. Make sure to smash the like and subscribe buttons down below. Additionally, if you want to know more about other investment options, just click this video right here. Thank you for tuning in and stay tuned for more exciting content in the future.